Hey, welcome back to Two Stupid Guys Try Stocks. I'm Dylan.
And I'm Vinny.
And last week we looked at timing of the rate cut and future 12-month returns. This week we actually correlated that with the labor market, and it is not what you think. It is actually really, really cool. The most important data point is not the FOMC meeting coming up. It is this week, and we got to pay attention to what happens here because history tends to repeat themselves. So let's take a look here. All right. So this is what we did last week. It was pretty interesting, right? There was only 2 negative returns after a rate cut after the previous 14 times in history, right?
Hmm.
So logically, this rate cut should lead to a positive 12-month return. We asked the community. I thought this was hilarious.
Yeah.
I'll save you the time. There's basically like 2 yeses, and then like throughout all the other comments, like 50 no's. So the odds of a recession, according to the main, everybody, no, there is not going to be a recession. I disagree respectfully,
Mm.
depending on this Friday's September numbers and the first Friday of October's numbers, not the FOMC meeting. The reason why I
Okay.
don't think that's important, I think we all kind of know there's a rate cut. It's just if it's 25 or 50 and it's really looking like it's 25. So that's not like a surprise. All right.
But the Friday numbers, you mean jobless claims. That's the thing you're going to be focused on.
Yeah. First Friday of every month, we get the jobless claims. So last time, the first Friday of August, we got the jobless claims. Unemployment went up to 4.3%. Everyone was very, very nervous. Goldman Sachs went from 15% to a 25% recession this year. However, they have changed that back to 20 because of this. So this is good news, but basically this is seasonally adjusted initial jobless or unemployment claims, but it's weekly, so you can see that we actually curved up here. So
Okay.
they're not worried about the rapid continuation. That makes sense.
Mhm.
Okay.
Makes sense.
Now, granted, this is not the best metric, hence why we got to make sure. Now, this is that super scary, convoluted slide. Bear with me. This is the 14 times that we have had a rate cut and then the following 12-month returns. So you
Hmm.
see, we only had 2 negative returns. That was in 2001, 2007, after the rate cut, and then
Yeah.
mostly positive and mostly very positive. Most of these are over 20% returns. So this is a big decision because you do not, you know, if people are thinking of shorting, people are thinking of staying cash because they're scared, which I think maybe this is just me. It looks like everyone else just wants to go all in, which
Yes.
at least look at this before you do that. What we're going to do, we're going to take a look at these 3 data points correlated with what was happening in the labor market a year before and a year after. Okay?
Okay. Why
So,
did you pick those three, though? Just out of curiosity.
oh, we're going to do all of them.
Oh, okay.
Yeah. But these 3 have the same pattern of the recession started
Okay.
large amount of time before the rate cut.
Perfect.
All right. And they're fast, don't worry. So, you have this is the rate cut, the red.
Okay.
And then here is 12 months after and 12 months before of the unemployment rate. Okay? So it's 25 data points, 24 months plus the rate cut month. The
Hmm.
pink is the market low, and then the green is the length of the recession, the start and the beginning, the start and the end. Okay?
Uh,
That makes sense?
yeah, I'm just trying to draw some sort of correlation from the data here and what it's trying to tell me.
So essentially, we're having a relatively low unemployment rate. Okay? Recession starts, we have a low in the market, and then your rate cut. So obviously, when you have a low in the market before the rate cut, the following 12 months are going to be fantastic. When I say low, I mean low for years, low for anywhere till the next recession.
Okay.
Okay? So you have your rate cut towards the end of the recession, your market low, and they all kind of have the same pattern of ramping up, ramping up, ramping up. This is the only one that's different because there's another recession 1 month after this data point. So
Hmm.
not ideal. Oh, I just realized you
Well, this
can't
is
see my
really
arrow.
a rate cut in response to a recession that's already occurring is kind of the pattern here.
Oh, you couldn't see my arrow that whole time. But yeah,
Yeah.
pink, red's rate cut, green's recession, pink is the low. So you can see we have this whole ramp up every time.
Mhm.
Except for that one. That one's a little bit weird.
Okay.
Okay. These are when the that's supposed to be X'd out. My bad. These are supposed to be when the recession was during. And it literally happened right after. So you have your recession, then you have your rate cut, and you have your market low. Okay?
Okay.
So the rate cut for these happens sometimes towards the beginning of the recession, not towards the end of the recession. Make
Okay.
sense? Follow me?
Yeah. So the market bottom followed the rate cut in these particular
Exactly. Which
recessions.
means, obviously, because you have a 12-month timeline of returns, you're going to have a solid year when the low was 1 month after the rate cut, right? Because you
Okay.
have 11 months of only positive gains because that was literally the low. This one you
Yeah.
have 8 months of positive gains,
Hmm.
i.e., happy. Everyone's
Okay.
happy. All right. This one's easy. So obviously our two options for our current scenario are not those because we're not in a recession right now before the rate cut. We already know that. And we're weren't in a recession before the rate cut. So it's either recession right after or no recession right here. So
Okay.
this is fairly easy to draw a correlation to. These 5 data points, no recession. Okay? It's the labor market, other than this terrifying, this is COVID. This kind of threw off this data point quite a bit.
Wow.
But you can see the labor market stayed within like 0.3% just for 25 months, which is pretty incredible.
Hmm.
It's just they're all hanging out. There's no ramp up towards anything. If anything, it went down a little bit. There's no change. Everyone's very happy. No increase in unemployment. Okay?
Okay.
This is the biggest data point. This is important. And
Yeah.
then,
I propose
look,
calling this the Dillon rule. It's like the Psalm rule. If unemployment doesn't increase by more than 0.3% after the rate cut, then we're golden.
it's good. I mean, if you want to put my name on it, I'm okay with it.
Yeah.
So now let's look at the only 2 negative returns. Okay? You have fairly stationary unemployment,
Hmm.
and then a rate cut, recession right after. This one, fairly stationary unemployment, rate cut, and then once again, recession right after, employment goes up. These graphs don't look as scary, but remember, this is 4% to 6%. That's a 50% increase. It's just,
Yeah.
that's
Well, I
gross.
mean, both of those times were kind of unique and interesting and within our lifetime. So it's things that,
Yeah.
we kind of remember and experience to some degree, whether or not you're actively trading it, you're at least aware of the backstory there in detail.
Yeah.
So, in those circumstances were unique, let's say, put it that way.
Though, I mean, I would say each one of these are unique. I mean, they all have very different socioeconomic things that were happening. There's like, especially in the 80s. I mean, it's like really hard to compare anything in the 80s to now. It's not really fair. But
Mm.
the interesting thing here is both of these, the low was not for, in this one, 20 months. Let me get my arrow back. After the rate cut, and this one's 17 months after the rate cut. It was a prolonged dip in the market. It was a very, very long recession.
Okay.
All right. Here we are right now. So obviously, I don't have the data points because I don't have the year after this. That would be awesome. You can see unemployment hanging out very, very stationary, 3.6, 3.8, and now we're starting to rise, and we haven't missed a step. This is it
Mhm.
augmented, just so you can see a little bit more. We're 2% the base. Same graph.
Mm.
All right. If the September numbers come out and October, I need at least 2 more data points, and they start to correct, I'm going to say odds are everyone's right. The next year is going to be pretty solid. Everyone's going to be very happy. But if those continuously increase, There has literally not been a scenario where unemployment goes from 3.6 to 4.6, almost a 30% increase, and there has not been a recession immediately and a direct negative impact on a 12-month S&P 500
Hmm.
timeline. It literally
All
hasn't
right.
happened.
So jobs are all that matters now. Got it.
In my opinion, that's, I'm just a YouTube guy who doesn't know anything. Um, so these are the two dates. I think that these are very, very important. Um, it's, you can never tell the future, but I can tell you, I really, really, the market looks toppy as hell to me. I don't like how we've gone so high and almost no volume whatsoever. I am not willing to start a short until I see these two numbers.
Okay.
I think it's a little bit foolish because no one really knows. We don't ever know what's going to happen. But these are the other three FOMC meetings. And then I just wanted to show you this. This is all the way since like 2000. These are the only times in those two recessions, 2001, 2007, that we were below the 200 for a sustained amount of time. We literally, it hasn't happened. We had COVID for like a week, and then nothing. It's crazy. We've been
Yeah,
in like an outrageous bull run.
I know. It's been nice.
It's absurd. I don't know how realistic it is, but yeah. Um, I don't know. Let us know what you guys think. I don't want to be all doom and gloom. I'm not 100% sure that it's going to be negative returns. I need the September jobs and the October jobs report before I can make a better educated decision. I don't
Yeah.
think the FOMC meeting is as important because we already kind of know what's going to happen.
All right. Fair enough. I just want to say thank you, man. That those were some interesting charts. It's not something I've seen anyone else talk about in this sort of presentation format. So cool. Cool. Nice work.
Could be completely useless. All right, guys.